Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 22nd of April. I'm Daniel Lam, your host for the podcast. One of the most frequent feedback regarding strategist views, and I'm talking about the general population of strategists, is that some of them concentrated too much on the end targets, but they do not talk about how we get there. Certainly, the psychology of investors would be very different if an underlying gets to its target price very smoothly versus the underlying going heavily the other way before eventually getting back onto the path the strategists expect and reach the target price. Now, by and large, the street is bullish the Japanese yen against the US dollar over the long term. Now, that may well play out eventually, but so far it is not going that way. The dollar yen has been garnering upward momentum over the last 6 weeks. The dollar side of the equation is gaining. Due to the strong US data, the street has been scaling down on the number of US rate cuts to expect this year, and the timing of the cuts pushing out further away. Meanwhile, the yen side of the equation remains weak. It appears that the BOJ is, quote-unquote, erring on the side of caution in tightening their monetary policies. Well, after all, who can blame them, right? Japan has been enduring balance sheet recession since the burst of their asset bubble at the start of the 1990s, and they have only recently just came out of a 30-year disinflationary process. So therefore, we are expecting the BOJ to maintain its current policy stance in its meeting later this week. Yes, it is true that the national CPI inflation rose to 2.8% year-on-year in February, from 2.2% in January. But industrial production declined for 2 consecutive months in January and February, primarily influenced by sluggish auto production due to the January earthquake. The job market has also been showing signs of sluggishness, with the jobless rate rising to 2.6% in March compared to 2.4% in February, and the job-to-applicant ratio decreasing slightly, reflecting fewer job opportunities. So therefore, it is possible that the dollar yen has a few more big figures to run higher in the near term, probably to around the 157 to 158 levels. And that's supported by technical indicators such as ADX and MACD. So how can investors who are holding Japanese yen be dealing with this? Well, we believe they should consider using those holdings and buy Japanese equities. Now, Japanese equities have been correcting alongside global equities, but there appears to be strong support at the 2,500 level for the Topix index, which is a few percentage points down from the current levels. That is all from me for today. As always, if you enjoy these podcasts, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.